Well, for more on the markets and the U.S. economy, let's bring in our Bloomberg best on new home sales and GDP, Hugh Johnson. He's the Chairman and Chief Investment Officer of Hugh Johnson Advisors, joining us from Albany, New York. Dom staying with me as well. Hugh, so we got a little bit of a disappointment on the ADP jobs report. How do you think the markets are going to digest this?
Yeah, I don't think the markets are going to take it that seriously. I think, most investors, economists, strategists know that these numbers jump around a lot from month to month. They're basically unpredictable. So I think it's not too far from the consensus forecast, which, of course, is that 185,000 jobs were added to payrolls in the U.S. We'll see that number on Friday, and maybe private sector jobs, something in the order of 195,000. But again, it's a very unpredictable number, and it looks to me, based on the ADP report, that we're going to come in fairly close to the consensus expectation when we see the numbers on Friday. So I wouldn't worry about them. So
does that mean then, Hugh, that the jobs number, if it stays consistent, becomes less and less of a factor in trade?
No, I think it's going to be a factor as time goes on, but it's got to show some improvement. Month to month, as you know, Betty, they jump around an awful lot. So I wouldn't really worry about any 1 month's numbers. But over time, what the markets have got to see is not only a growth in the economy, but particularly that's got to show up in growth in jobs. We've got to move from the 200,000 jobs per month added to payrolls up to somewhere in the neighborhood of 250,000 jobs as we move through 2011. I think that's going to happen, but you have to have that happen for the markets to continue.
Hey, Hugh, it's Dominic here. Given the volatile nature of those jobs numbers, how prominently do those kind of numbers play into economic models, say yours, for instance? We heard other people talk about this idea that they use other factors. John Sylvia over at Wells Fargo saying he looks more at the employment components of certain manufacturing indices. Is that something that we want to look at more than, say, the ADP jobs number?
Yeah, you can't look at the ADP job numbers. You have to look at the total job numbers. You have to look really at just about a number of variables in the jobs report itself to try to tie up the growth in employment to the growth in, let's say, personal income, which is an important part of the consumption calculation in GDP. So he's very right. You just can't rest on the ADP numbers alone. They're just not enough.
Hugh, why are investors rotating into more defensives?
I think that, first of all, since the middle of February, the risks to investors have gone up a little bit. That's obviously because of the rise in oil prices from $83 to roughly $112 per barrel. But it's also because of Japan, which you can't trivialize. It's a very important player in the global market. So the rise in these risks has obviously raised some questions about what's going to happen to the global economy in the remainder of 2011.
Doesn't that mean that this market is toppish? Because if you've got the defensives leading the way, what legs do you have for a further bull market?
No, Betty, I would say that ordinarily I'd be worried about it, and I am a little bit worried about it when I see a shift towards defense in sector performance. But this is normal in the third year of a bull market. It's not just the risks that have been rising, but in the third year of a bull market, you have rising rates. Sooner or later, we're going to get rising rates. Investors know that, so they start to play it safer. And the most important factor is the year-over-year comparisons, earnings comparisons, start to get much tougher. You're not going to have 17% growth in earnings year over year like we had in the first quarter. By the time we get to the fourth quarter, we're going to be talking about something closer to 8%. So rising interest rates, tough earnings comparisons, you get a 6% to 8% rise in stock prices in the third year of a bull market. This is very normal.
Hugh, traders have been talking for a long time about a top. We've been fighting it for about 2 years here now. But is there any one catalyst besides just earnings stories overall that will send this market lower? Right now we continue to see strength.
Well, you'll get corrections along the way, Dominic, and I can't forecast those corrections. But as far as the end of the bull market and the start of a bear market, what you have to start to see is interest rates have to get to a level that it really threatens the economy, that will look like that we're going from a recovery in the economy to a recession. Okay. You look at leading indicators for the economy. They haven't turned down. They've been continuously rising. So you just don't have those signs.
Hugh, thank you.